The economy in the United States is the largest economy by nominal GDP and purchasing power parity. Also, the United States has the most technologically powerful and innovative economy in the world. On top of that, the US dollar is the most used currency in international transaction and is perceived as a reserve currency. But now, even the United States, inflation is a worldwide problem. More economies are looking at the United States, how they will combat inflation. Would you like to know how they will combat inflation in the United States? Well, keep watching. Welcome to the Ecocation channel, where we keep you informed of all major political and economic subjects worldwide. Don't forget to like and subscribe to our channel and press the bell icon to never miss an update. Not only in the United States, but worldwide, inflation is rising rapidly, but a lot of economies are looking at what the Federal Reserve will do in order to combat rising inflation. In the first half of 2021, they thought that inflation was transitory. Even the front leaders of the European Central Bank still think that inflation is transitory and will come down next year. But if we look at the actual data, especially the most recent data, we see that inflation rose to 7% in December, compared to the same month a year earlier in the United. This was the fastest rise since 1982 and marked the third straight month in which inflation exceeded 6%. If we take a look at the so-called core price index, which excludes the often volatile categories of goods and energies, that climbed as well with 5.5% in December from a year earlier, the highest increase since 1991. The last time the consumer prices clocked in at such an annual increase was in June 1982, but the circumstances were very different compared to today. As we see, inflation is rising nowadays, but back in 1982, it was falling after peaking at 14.8% in 1980, when Jimmy Carter was still president and the Iranian Revolution had pushed up the oil prices. By then, Paul Volcker, the newly installed Federal Reserve Chairman, had set out to crush out inflation by rising interest rates dramatically, causing a brief recession in 1980. By the summer of 1982, both interest rates and inflation were falling sharply. Today, the COVID-19 pandemic has caused supply chain disruption and a shortage of goods and materials, coupled with strong demand from consumers. For example, LA's port highlighted the global supply chain crisis last year. The main problem that occurred in the port of LA is that the port terminals had no room left for containers in their yard. As a result, more than 70 ships carrying a total of 500,000 containers were left idling in the San Pedro Bay, waiting for space to open up. But how is this even possible? Well, the economic effects caused by the COVID-19 pandemic are more than visible everywhere you look. For example, from half-empty shelves in the grocery stores to soaring fuel prices. Economies contracted sharply in 2020 as many countries went into lockdown, shutting factories and cutting the supply of available goods. As we rebuild from the pandemic, demand is soaring and suppliers and logistics companies are struggling to keep up. These are one of the main drivers, what is causing the rise in inflation. Besides the supply chain distribution, quantitative easing caused also a rise in inflation. But what is quantitative easing? The Federal Reserve Bank purchased debt securities in order to provide liquidity in the market. How does that work? Quantitative easing is a form of unconventional monetary policy where a central bank purchases long-term securities from the open market in order to increase the money supply and encourage lending and investment. This results in adding new money to the economy and also serves to lower interest rates. On top of that, it also increases the central bank's balance sheet. Back to what the Federal Reserve Bank did in order to support the economy. At the beginning of the COVID-19 pandemic, the Fed said it would buy at least $500 billion in Treasury securities and $200 billion in government-guaranteed mortgage-backed securities over the coming months. In March 2020, they made purchases in the open market, saying it would buy securities in the amount needed to support smooth market function and effective transmission of monetary policy to broaden financial conditions. In December 2020, the Fed updated their guidance, saying it would slow these purchases once the economy had made substantial further progress towards the Fed's goal of maximum employment and price stability. And of course, quantitative easing caused an increase in the balance sheets of the Federal Reserve, and you might have read articles about it or seen it on TikTok or other social media platforms that the Fed has printed 40% of the US dollars. These messages scare people and cause hysteria. But what does this figure even mean, and is it really that big of a deal? A simple answer: it is not that big of a deal. The answer is a bit complicated, but let's get some facts straight. the Fed did not really print 40% of the circulating US dollars in the last 12 months. In fact, most of the money was not printed at all. The Fed used quantitative easing to prevent the economy from a severe crash, and most of the money is still with the government, but then in different forms, for example, mortgage-backed securities and treasuries. The Fed bought these financial instruments from financial institutions in order to help the financial institutions afloat and escape massive losses. It is very important that these financial institutions escape very big losses, otherwise the economy would have looked worse than it is now. Think about the deflation of the US dollar or a crash of the banking systems due to not enough liquidity in the market, for example. But the Fed has always the right to sell these financial securities back to the financial institutions as the price matches pre-COVID-19. So most of the money does not actually go into circulation within the public and remains electronic. In November 2021, the Fed announced for the first time that they would reduce their stimulus program that has been in place since the early stages of the COVID-19 pandemic. Central bank policymakers worried more about the rising prices and inflation, which has been rapidly increasing in 2021. The officials of the Fed announced they will reduce their $120 billion stimulus by purchasing $15 billion in financial securities starting in November. At this point in time, the officials of the Fed still believe that the rising inflation will fade and the labor market will lure back workers, which hasn't still been on the level since pre-COVID-19. But this changed in December. The officials of the Fed announced they will buy $60 billion of bonds each month starting in January 2022. Jerome Powell, chairman of the Fed, said at the post-meeting news conference, economic developments and changes in the outlook warrant this evolution of monetary policy, which will continue to provide appropriate support for the economy. Officials of the Fed have long stressed that inflation is transitory because prices are booming due to the pandemic-related factors, such as extraordinary demand. But their vision of transitory inflation has changed and therefore changed their monetary policy. But this goes even further. The Federal Reserve began making plans to start cutting the amount of bonds it is holding on their balance sheets in December. They did not make clear when they would actually start reducing their balance sheet, but the statements indicated that the process could begin in 2022, possibly in the next several months. They stated, almost all participants agreed that it would likely be appropriate to initiate balance sheet runoff at some point after the first increase in the target range for the federal funds rate. The balance sheets of the Fed is really significant because the central bank's bond purchases have been considered a key element in keeping interest rates low while boosting the financial markets by keeping money flowing. But what we see now in the market is that economic experts are saying that they expect at least 3 hikes in 2022, which means that the Fed will increase the interest rates 3 times this year. Also, according to the economic experts, they expect an increase of at least 0.75% in 2022, 3 more hikes in 2023, and 2 more the year after that. What could this mean for us? Higher interest rates mean that, for example, borrowing money would be less attractive, or spending money would also be less attractive, and we could save more. Because, for example, an increase in the interest rate will automatically mean an increase in the rate of a mortgage loan. It would be less attractive for consumers to pay 2% interest instead of paying 1% of interest. Meanwhile, this also means that the interest we receive on our savings account will also increase. Who doesn't like free money? People will save more during periods of high interest rates, and eventually this will slow down the economy, which is necessary at this point in time with more demand than supply. What do you think? Will Federal Reserve indeed increase the interest rates? And what kind of effect does it have on our personal spending behavior? Let it know in the comments. For more interested topic of worldwide politics and economic subject, like, subscribe, and put your notification on in order to always be updated of what is going on in the world.